Hey there, we're live. Nice to see you today. Thank you for joining me. I'm Mitch Goldberg. You're watching my live stream. It's called Be the Boss of Your Money. It's about taking control of your money. We talk about a lot of things here. We're going to go over the new updates and how much you can add to your retirement plan tomorrow. And we're going to talk about some changes in the tax rates also. When I say that, I don't mean the tax rates have changed. I just mean that the income levels have been raised slightly. So if your income went up a little bit, it doesn't automatically put you into a higher tax bracket. We'll talk about those things tomorrow, but today just want to get down to some different kind of business in a way that we normally don't start the show. Yeah, you have to wait a second because Microsoft and Google's earnings just came out and they were, wow, swing and a miss. It's like the last thing you want to see after everybody gets ginned up after a big rally last week. That continues into this week, and then you see Microsoft and Google miss, and they missed by a good amount. It wasn't like a little miss; it was a lot, and not even the cloud could carry the day. Uh, they're cloud computing businesses, so this is a bit of a shocker, and I think it's probably setting us up for a negative day in the market today, rather tomorrow. So we're going to take a look at that, what to expect. But let's just roll the quick intro. We're going to do a quick show today. I'm going to just give you the goods and stick around. If you have any questions, please ask me in the comments. That's what they're there for. I love hearing from you. It's the best part of doing this, by the way, hearing from you. Or if you just want to say hi or what's up, that's always cool too. And while you're watching, hey, give us a thumbs up, a heart, an applause, depending on which reaction is available to you, depending on which social media platform you're watching on. We stream over here, LinkedIn, Facebook, YouTube, Twitter. We don't stream on Instagram because it's not quite, I know there's Instagram Live, but it's not quite the same as the streaming that I do to the other platforms. But I do post on Instagram a lot. So follow me on any one of these platforms. If you're following me on one, maybe consider following me on another because sometimes I really do post different content on different channels. So it's all there. Go ahead, connect with me, and let's roll the quick intro. Here we go. Now, I did say here we go. All right, we're just getting started here. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's a show about taking control of your money, not your money taking control of you. We talk about a lot of things like process, like having a steady investment process. Can I tell you something? I talk about a lot what just pops into my head. I don't really script out a whole show. I maybe come up with a bullet point or two a little before the show that I want to talk about. Sometimes I really delve into a topic that I'll study for weeks to make sure I have it down perfect. But most I want to give you a quick update. I want to talk from the heart, and I talk to you like I'm talking with any other friend. So thank you so much for joining me. The best investors. What are the best investors doing differently? And what separates the best investor from you? Why does it seem to be that some people are just better at investing than others? They're just good at it. You know people like that, right? You know people who just, oh yeah, he's a good investor. Oh, he does great. She is the best investor. She just knows how to do this. I always go to her for investing advice. And then there's other people who are like, every time I touch something, it goes down. Every time I buy a stock, it goes down. I was talking to somebody today, this morning, a dear friend, and this person asked me about Tesla. Should I buy it? I bought some. Should I buy more? And it was up a little. It was up today, so to her, it validated the decision. I'm like, you know, why Tesla? If you want to own it, then the easiest thing to do, the straightest way to owning Tesla, if you want to own it, is to just buy it. Does it fit with your plan? Is it, and she said to me, I'm just so sick of these little companies. I take shots, but on companies, but if a stock's over $100 or $200, I can't buy a lot. I really feel like I can't make money. And I'm trying to explain to this person, it doesn't matter how many shares you buy, it's percentage. Making 20% on 10 shares or 20% on 100 shares, if it's the same amount of money, Who cares? And this person says she always gets burned and sees stocks go to zero. It's really bad. We have to change that. Please change your thinking. Don't think for a second that because you buy a lower price stock that somehow means you have more upside. You're leveraging yourself to make more money because it's a lower price stock. Well, if $1 stock goes to 2, it's 100%. If $100 stock goes to 102, it's 2%. Well, and if the dollar stock goes to $1.02, it's 2%. So what? Is that means nothing. You're okay, great. So you know a tiny bit about math that has nothing to do. That has absolutely nothing to do with inflation, with investing. It has nothing to do with investing. Quality companies has something to do with investing. Now, stocks at a year low. So a lot of people are like, well, what's the high and the low? And I was asked that. I do get asked that quite often by investors, by clients. Well, what's the low? What's the high? I'm like, first I'm thinking to myself, thank goodness the accounts I manage are on a discretionary basis, so I don't have to actually get into that with somebody. But if I am asked, they don't mean anything. Okay, the year low, people think that a year low on a stock somehow means that like it's a floor. Oh, the stock's 120, but the low is 110 and the high is 160. So it's got more upside than downside. From 120 to 160 is 40 points, but from 120 to 110, which would be the low in this example, only 10 points of downside. No, that has nothing to do with how much upside or downside you have. $110 year low, that stock could go down to 5 or 2 or 0. I just want to reinforce this. The buying a stock, or let me just say it like this, a year high on a stock does not mean it's a ceiling on how high the price. You're like, oh, it's going to hit the high. It'll never go above that level again. In fact, it'll bounce right down and go straight down. No, it doesn't mean that. And a year low doesn't necessarily mean that a stock has a floor under it, that it can't go any lower than that. The year low, year high means nothing. Most of the time, what it tells me is when I look at a year high, and I'm looking at a lot of stocks with much higher year highs than where the stock is now. And it's not little speculative companies. It's not just pandemic stocks like the Netflixes, the Zooms, or the DoorDashes. Okay. It's companies like Procter & Gamble, Boeing. We could also take a look at Google, Alphabet, Microsoft, Facebook, which is now called Meta. It doesn't, to me, when I look at those highs, it just tells me that, you know what? They probably should never have been to those highs in the first place because it was a reflection of other things like interest rates or investor enthusiasm, investor psychology. These are not lasting things in a lot of cases. We think more in terms of what gets a stock going up from where it is now. When I buy a stock, I'm not looking for a particular price in mind. I buy a stock at 100, I see it 150, I'm selling it all, I'm gone. I don't know. I think when people are trying to bring in some kind of control, which is what we crave control. I think they're looking at year highs and year lows because they think they've got some kind of control over things in a business of investing that you have no control over. You have absolutely no control over what stocks you're going to do, year highs, year lows. Not even the management of these companies has any control over it. In fact, most good CEOs, I think I'm going to say good CEOs of good companies don't even look at the price of the stock. They execute their plan. They work to push the ball forward, advance the ball on a day-to-day basis, knowing that there'll be setbacks along the way, but they look to perform day in, day out. Okay? They're not looking to just do some magical Sunday punch and everything will be fine and the stock will go up and they retire. That's not what they're looking for. When I ran track and field, I used to be a track and field guy. And I used to run, and the track coach would say to me, Mitch, you focus on the race. You don't look at the scoreboard, all the way to the side, like around the football field. There's a track goes around the football field. So we got the scoreboard. There's also a timer on it. And he used to say, don't look at the timer. Just focus on your race and winning your race and your strategy and your style, not the timer. You're not going to win any races by looking at the timer. Okay, like football games, you're not going to win football games by looking at the scoreboard. You've got to focus in the field, trust the process. I hope this makes sense to you. All right, so we're going to start today with a screen that we usually don't look at because we've been in a really good position. The market's been rallying, so in a way, we're kind of set up for disappointments. And we have someone out there. We have Stone. Hey there. Hey there, Stone. Thank you very much for watching. I greatly appreciate you being here. Stone, is that like, is that, is that your whole name? Are you just Stone? That's a cool name, Stone. I know people whose last name is Stone, by the way. Hi, Stone. Nice to meet you. Thank you for watching. Greatly appreciate it. Come on, guys. You got to have a question or something out there, say hi. But, all right. So let's take a look at this. Things are looking really, really good. Stocks are moving. Let me get rid of the social media icons. All right, just get rid of those. Okay, that's better. All right, we're looking really good. Netflix was up $8 today. I mean, 162 to 291. Netflix is way, way above its 52-week low. I'm just giving you an example of how far the stock has come. Again, I don't think a year low or a year high means it's a bottom or a top for a stock. It's not a floor underneath the stock. A year low is not a floor underneath a stock, and a year high is not a ceiling above a stock. But Netflix up $8 over 3%. Nvidia up $6, up over 5%. Microsoft has been on a tear lately, moving up over $3 today, up over 1%. Google up almost 2%. I know it's called Alphabet, but I'm just used to Google. Amazon up a little bit, but it's been moving up. And Apple's been moving up. Amazon, Meta has even been getting off the ground. So it looks good. And these are big moves, $7 moves, $3 moves, $8 moves. These are the kinds of moves where stocks just gallop ahead. And all of a sudden, like a month later, you're looking at them and you're like, these stocks just doubled. I mean, that's what happens with these stocks. But then Microsoft and Google come out with earnings after the close, earnings and revenues, and they both disappoint. And it wasn't like a little miss. It was a pretty sizable miss. Now, a lot of this could be explained away, but let's see how things change. I'm going to make this a little smaller so we can see more in one screen, okay? I'm going to make it even smaller. It's just, I'm really looking to show you everything in one screen. So here they are. Netflix to Meta, all up nicely. What happens when we look at the aftermarket trading? Ooh, you see that turn red? Netflix down, Nvidia down over 2%, Microsoft down $4, Alphabet down over $6, Amazon down $2, Apple down, Meta down $4 and change, almost $5. Look at how bad the aftermarket action is. This does not bode well for the NASDAQ tomorrow. It doesn't bode well for the Dow. It doesn't bode well for the S&P 500. By the way, guess what I'm about to say? That's right. You know it. You can't invest in an index, but you could invest in a security that tracks or mimics an index. Pow! I said it. So if you look at this, just part of the problem is not so much that Microsoft and Google missed, but people started to really buy into the thought process that, you know what, we're going to have a really good earnings report from them. Earnings season so far has been pretty good. More than 70% of companies have been exceeding expectations, even if they're lowered expectations. A beat is a beat. The market went lower, so it's okay if the expectations are lowered. The bar has been lowered, but the overall market was lower also. So the market's been going up. People started feeling pretty optimistic. I saw something, Bank of America report that investors right now are buying individual stocks at a record pace. I do find that rather surprising. In any event, investors are coming back into the market. But then you get this reminder, this subtle reminder. We went from this, all green, to this, all red. Not what we want to see. That's what we're going to see tomorrow, and that's what happens when companies miss. Let's take it to the big boards, okay? Let's make the screen a little bigger. All right. So the Dow today up 300 some odd points, continuing the last couple, continuing the bullish market since last week. S&P was up, Nasdaq was up. I mean, Nasdaq was up over 2.25%. Wonder if it's going to give it all back tomorrow. 10-year yield was down to 4.01. We could see that in the threes again. By the way, the fact that companies are missing earnings expectations, that could hurt, obviously, revenues, earnings, and kind of indicate that the economy is slowing down. Maybe it'll hurt hiring a little bit. That actually will prove to be a good thing for the market because bad news is good news. Meaning, if there's bad news, it stops the Federal Reserve from raising rates, or at least it slows the Federal Reserve from raising rates. When the Fed raises rates, interest rates go up, they slow the economy down, and the high-flying stocks go down the most. A high-flying stock is a company with a minuscule amount of earnings per share that's trading up an awful lot. I'm not talking about a dollar stock that has a 50 cents earnings, so a 2-to-1 P ratio. I'm talking like the stock that's trading at $200 a share that earns like 2 pennies a share. That's a high flyer, and those are the ones that get hit the hardest when rates go up. It has to do with how the discount rate works. The lower rates go, the more those future earnings expectations become. And the opposite, when rates go up, the lower those future earnings expectations become. And companies that are trading at huge valuations are trading because they're expected to make a lot of money over the next 3 to 5 years. So we're overlooking the fact that they make like no money now. We're overlooking that, okay? That's what a high flyer is. Hope that makes sense to you. And we, so high flyers get hit. But we've been in a pretty good market last week and a half, like starting to feel pretty good. Like here comes our, rally that we've been looking for into the year end. We'll see if it lasts. But this Google, Microsoft numbers is terrible. Tomorrow morning, Apple comes out, Amazon comes out with earnings. Those are the next two big ones. So we'll have to see how those do. And the VIX was off a little bit. Let's take a look at the bond market. Bonds yields are down. So you see, let me show you. You see this red over here, this red column, this whole column over here. That's been green for a long time. Rate meaning those are going up. When they're green, interest rates have been going up. Interest rates are finally starting to go back down again. Now I don't know if this is a lasting thing. This is really like a today thing. But if companies like Google and Microsoft are warning about the economy, and they're saying we could go into a recession, or they're saying things are not as good as we thought, it's not great for the economy. It doesn't reflect well on the economy, and it doesn't reflect well on hiring. But that's precisely the news that the Fed is looking for. So if the Federal Reserve could slow down its pace of interest rate hikes or stop them altogether, that would be reason enough for the stock market to keep going up. So bad news is actually good news. But we are talking about Microsoft and Google, who are two pillars of the stock market. So not such great news. I'd say it's more negative than good. In any event, I appreciate you taking some time to watch this. We'll see what things look like tomorrow. I greatly appreciate you taking the time to watch. If you have any thoughts about what I should talk about or what you want to learn about, let me know in the comments, and I'll be sure to study up on it, and we'll talk about it right here on Be the Boss of Your Money. Thanks so much, and have a great day.